So conversion of a partnership. So I think we had already started looking at a few things regarding conversion of a partnership. And I think we had left the class, or the previous class, we left up a point whereby we had mentioned the different kind of accounts that can actually be prepared when you're having to convert a partnership. And we said in this case, when you're having to convert a partnership here, we are looking at you converting the partnership into becoming like a company. So you convert it from a partnership form of business to becoming a company. So when the new company is having to be formed, there are a number of accounts that will end up having to be created. So for example, we said we can have a business purchase account. The partner's capital account will end up having to be adjusted. Then we'll have like a vendors or purchasing company account. And of course, also you can be able to prepare what you call a realization account. So we were to start by having to look at the format of these accounts. Start by having to look at the format of these accounts. For example, the first account we have there is what we call the business purchase account. So the business purchase account. The business purchase account. So the business purchase account. So what is actually contained in the business purchase account? We can look at what in this case you'll end up having to record in the business purchase account. So in the business purchase account, you'll credit these accounts. You'll credit this account with the assets taken over by the newly formed company. So you'll end up having to credit this account with the assets taken over from the partnership, So you'll put all those assets that have actually been taken up here. Then on the debit side here, you'll be able to put the liabilities that have actually been taken over. So liabilities taken over by the newly formed company. So you'll debit them. So of course, at the end of it all, you'll end up having to get a total. You'll get a total. And of course, you'll have a balancing figure. There'll be a balancing figure here, which in this case we'll be able to refer to as what? As the purchase consideration. So purchase consideration. So in this case, you'll have your purchase consideration, which in this case will be the equity. This will be the equity for the newly formed company. It will be the capital for the newly formed company. So there will be the purchase consideration here. In brackets, this one, ideally, it will actually be the equity for the newly formed company. What you're having to say, this balancing figure you get here, we'll be able to consider it as the capital of the newly formed company. We'll be able to consider it as the capital of the newly formed company. And of course, we'll be able to see when we look at our question, how eventually we'll carry that figure. And eventually, when we are preparing the balance sheet or statement of financial position for the newly formed company, we'll be able to consider this one as what? As the equity. Remember, these assets you're talking about, these assets are the ones that were in the partnership. The liabilities are the ones that were working in the partnership. They've been taken over by the newly formed company. The balancing figure there, it is the equity for the newly formed company. So that is one of the accounts in this case you'll end up having to prepare. Then in this case, we said also, you can be able to prepare now, in this case, the partner's capital account. You'll prepare the partner's capital account. You'll prepare the partner's capital account. And of course, when you talk about partners here, it means that it is not a single person. So there'll be a consideration of a number of partners who are in that business. It is not a single person. So in this case, we can have like two partners. So you can have maybe partner A and partner B. So you can have partner A and partner B who have actually been in that business. We can have partner A and of course partner B. So partner A and of course partner B. So like that. So here you would have been given the balance brought down. So the capital that has actually been brought down by the partners. So the capital or the balance brought down, capital or balance brought down of the partners. So for partner A, you'll be able to credit there. You'll have the opening balance. Then when this partnership is having to be purchased, there can be a goodwill. Just the same case in this case, when you normally do the computation for group accounts, there's normally a goodwill that actually arises. So depending upon how they are sharing in terms of ratio, that goodwill will have to be apportioned amongst the partners. So this is part of the benefit they'll be able to get. Then also, you can have now in this case the balances for the current account. The balances for the current account can actually be placed here, or alternatively, you can prepare this current account separately. You can prepare the current account separately because this current account normally captures things like, let's say, for example, salaries which are having to be paid to the partners, maybe interest that in this case was actually maybe realized by the partners. So in this case, you can actually be able to have the balances for the current account also having to be placed here. Then you consider any other adjustments that you normally make to the current account. For example, in this case, we can have the profits which they might have shared, by the end of this business when they're having to convert it. There can be a revaluation gain they might have realized, revaluation gain that might have been realized. You can place it there. Then maybe salaries. They might have been paid salaries. These partners might have, that is part of what you normally adjust in the current account. So you'll credit it here, salaries to partners that they were supposed to have realized by the time they were converting. Maybe there can be a commission to the partners. There can be a commission to the partners. So you'll also end up having, so all the benefits that in this case the partners realize, you'll credit them in the partners capital account. Then on the debit side here, in any case, for example, these partners, maybe during that year, they're having to convert the business, they made some drawings from this partnership business, you'll have to place it here, you debit. There can also be what we call realization loss. They can be what we call a realization loss, a realization loss. There can be a realization loss. Maybe they might have incurred a loss when this company was having to be purchased, so realization loss. Then in this case, there can be goodwill written off. Goodwill written off. So it is this side, but if you write it off, for example, if you amortize it off, then you'll debit it, you'll remove it this side. So you'll end up having to put it there. Then you can also, in this case, put the purchase consideration. Put the purchase consideration. Put the purchase consideration here. You'll end up having to put the purchase consideration there. The purchase consideration there. So this will likely be the balancing figure here. So if there's actually any loss, it will likely be placed here. If there's any realization gain, you'll place it here. So if in this case, at that point in time, they're having to transfer the partnership or convert the partnership and they realize that loss, so the balancing figure will likely be on this side if it is a loss. If it's actually a gain, it will likely be on this other side. It will likely be on this other side. So in fact, this one is supposed to be realization gain. Realization gain. So this one is supposed to be realization gain. The realization gain. Realization gain. Realization gain. So this will be the balancing figure if it happens that in this case, this particular side is more than this side. This will be the balancing figure. If it's a loss, this will likely be the balancing figure here. So that is what you'll end up having to get there. So you can be able to have the totals. You'll have the totals. You'll have the totals. Then you can be able to total your partner's capital account. You'll total the partner's capital account. Then you can also, in this case, prepare what we call a realization account. You can have, in this case, a realization account. A realization account. A realization account. A realization account. We can have the realization account here. So the realization account. Can have the realization account. So in this case, you'll put on the debit side of the realization account, all assets at net book value will be debited. So all assets at net book value will likely be debited. All assets at net book value will likely be debited. Then all liabilities, all the current liabilities taken over. Current liabilities taken over will also be credited. Current liabilities taken over taken over will have to be credited there. Will have to be credited there. Then also assets which are actually taken over. So assets taken over by the partners, taken over by the partners. Maybe they took over some assets, they never transferred them. Assets taken over by the partners. By the partners, you'll end up having to credit them. So if in this case, all of them are having to be transferred, you'll debit all those ones which have actually been transferred. But if it's taken by the part, credit them, you reduce them here. You'll end up having to reduce them there, so you'll credit there. And then in this case, you can be able to put the purchase consideration. The purchase consideration, you'll put the purchase consideration there. Then also in this particular account, you'll be able to have the realization. You'll have the realization loss. You can have the realization loss. They are having to be the balancing figure. They are having to be the balancing. This will be the balancing figure. It is on this side, so it will be a realization loss. But in this case, if it is actually a realization gain, then it will actually be on this side. Realization gain. So which also will be the balancing figure if it happens that this side is actually more than this side. So then you'll end up having to get what your totals. So you can copy those ones. You can copy those ones. So that is the business purchase account, the partner's capital account, how it will be presented, and of course the realization account. The realization account. So that's how you end up having to create those accounts. So this one is the current liabilities taken over, assets taken over by the partners, purchase consideration, then realization loss. Then in this case, these are all assets taken over at net book value. Then the balancing figure in this case, if it is on this side, it will be actually be a realization gain. It will actually be a realization gain. So if you are through, you can inform me. If you are through, you can inform me, so that we start looking at an example. We start looking at an example, how you'll end up having to create these accounts. I can see you are saying done. So I can see you are saying done. So that is okay. So I want us now in this case to look at a past paper question. So there's the first question you're going to look at. It is May 2016, question number 3. So try to see whether you can be able to open that question. May 2016, if you get it, let me know you've gotten it. May 2016, question number 3. So May 2016, question number 3. May 2016, question number 3. 𝗖𝗙𝗙𝗘 has been able to get it. So we can start. We can start. So the question is there on the screen. In the meantime, the question is there on the screen. So we can go through the question there. It says, Faith and Hope were partners in a business of a manufacturing and distributing manufacturing and distributing construction materials, sharing profits and losses equally. So they were in a partnership, and of course they were having to share their profits and losses equally. The partners agreed that with effect from 1st of January 2016, the business be split off and transferred to two separate companies. So Mabati Limited and Nyumba Limited. Mabati Limited took over the manufacturing business, while Nyumba Limited took over the distribution business. The partnership statement of financial position has actually been indicated there. So we have the accounts receivables as of 31st of December. This is how the business, this was the partnership, how they were running. So the accounts receivables had actually been split into manufacturing, inventory had been split. The capital for the partners is that by that time. So then in this case, you have what the additional information. Then you are called upon to prepare, first of all, the business purchase account, the partner's capital account, the bank account, the vendor's account, and the statement of financial position for the two companies after formation. What you can be able to realize here, it is that we are converting the partnership business into two companies. We are converting the partnership business into two companies. So we are converting the partnership business into two companies. And therefore, first of all, in this case, what we've been called upon is to prepare the business purchase account. The business purchase account. We're having to start by having to prepare the business purchase account. So part A, it is the business purchase account. So the business purchase account. The business purchase account. And of course, in this case, in our format, if you can be able to look at the format, hope you've been able to capture it. We are saying in the business purchase account, this side will end up having to credit what assets which were taken over by the company. Assets which were actually taken over by the company. Then, of course, this other side will be able to put the liabilities which were actually taken over by the company. So we'll have in this case what you're calling what the business purchase account having to be created. So that in this case, you can be able to get what you're calling what the purchase consideration. We are going to look at how in this case, how much, for example, was actually paid as a consideration by these companies to acquire what this partnership business. It is not just for free. They're having to purchase this partnership, and of course they have to pay something. So they have to pay what we call a consideration. So what did they actually, for example, in this case, pay for them to acquire this partnership business belonging to Faith and Hope? So, and of course, in this case, we've been told that two companies are having to be created. So therefore, in this case, it means our business purchase account will be split into two because there are two companies. Sio company moja, there are two companies. Sio company moja, but there are two companies having to be created. There are two companies having to be created here. Sio company moja. It is not one company. It is not one company. And there's something in this case we've actually been told in the question. If you can look very keenly there, you've been told they were in the business of manufacturing and distributing, sharing profits and losses equally. So to two separate companies, Mabati Limited and Nyumba Limited. So in this case, there are two companies having to be created here. We have Mabati, and of course we have Nyumba. Mabati, and of course we have what? Nyumba. So of course Mabati is going to take over in this case what? Manufacturing business. It is taking over the manufacturing. It is taking over the manufacturing. It is taking over the manufacturing. While in this case, Nyumba is taking over the distribution business. The distribution business. The distribution business. So that is how in this case, they are going to take over this what? Partnership. So there is that arm that is dealing with manufacturing. That one will go to Mabati. Then in Nyumba, they'll take over what? Distribution. The distribution arm of the business belonging to this what? Partnership. So in our first note, there, Mabati Limited took over all the non-current assets, cash, bank overdraft, and its share of account receivables, inventory, and account what? Payables. So Mabati Limited, which is one of the companies here, so you have Mabati and of course Nyumba. We have Mabati and of course what? Nyumba. So Mabati and of course in this case Nyumba. So if you look at the question here, you're having to be told that Mabati took over all over the non-current assets. And of course, you said in the business purchase account, you credit the assets taken over. So it means, what are the non-current assets? They're all these ones. Senior manager will credit, in this case, Mabati with all these ones. So because they took over all what? The non-current assets. In the business purchase account, you credit the assets taken over. So we'll credit all these ones under Mabati because they are the ones who took over what? All the non-current assets, which are actually these ones. So in this case, we comfortably go to our business purchase account. And of course, now in this case, we indicate what was actually taken over as the non-current assets. So the first asset taken over in this case as a non-current assets is actually buildings, is actually land and buildings. So we have land and buildings. Land and buildings. Land and buildings, it was an amount of 200 million. It was an amount of 200 million. Then motor vehicles. It is an amount of 150 million. 150 million. Then which other non-current asset they took over? We have the equipment. So equipment was at a value of how much? 33 million. So they took over all the non-current what? Assets. So those ones will end up having to credit under Mabati, not under Nyumba, because Nyumba never took over those ones. Then if you further read the note, you're having to be told that if you further read the note there, so just a minute, the question has gotten lost. The question has gotten lost a bit. So they also took over the cash, bank overdrafts, and its share of what? Of the account receivables. So they took over. So you have the papers. So I don't have to display. So I think I'll just be able to proceed without having to do what? To display there. So in this case, you're having to be told, so I don't have to display. So they took over also in this case, what? Cash, bank overdraft, and its share of what? Of account receivables. So they took over cash. And of course, in this case, what is the amount of cash you're having there? It is actually 1 million. And of course, in this case, they also took over what? The bank overdraft. The bank overdraft in this case is actually on the side of what? Current liabilities. On the side of current liabilities, which in this case comes to how much? It comes to, in this case, to an amount of 24. Is it 24 or is it 179? It's actually 179 million. Actually 179 million. So we've said in this case, the current liabilities you debit. So bank overdraft, they also took over that amount of 179 million. 179 million. They took over an amount of 179 million. Then, and its share of account what? Receivables. If you look at the accounts receivables, what is the share they are supposed to take? In your accounts receivables, what is the share they are supposed to take? So they took over the share of what? Of accounts receivables. What is Mabati supposed to take? Accounts receivables. Regarding the account receivables, what is amount is Mabati going to take? The account receivables, what are they going to take? I can see you're saying 460. 128. So I think it is exactly 128,000. It is exactly 128,000. While in this case, Nyumba will take their share. What will be the share for Nyumba? What will be the share for Nyumba? Because you can be able to see it in the balance sheet there. Nyumba were taking over what? The distribution business. Nyumba were taking over the distribution business. So it means Nyumba, they'll take over how much? They'll take over how much? Nyumba. The accounts receivables. Nyumba were taking over the distribution what? Business. So 216 is actually 216,000. 216 million. 216 million. So that's why in this case, they end up having to share what? The accounts, the receivables. So also in this case, they took over the share of what? Their share of inventory. So inventory watachukua ngapi hawa Mabati? Mabati wanachukua ngapi inventory? They took over also their share of inventory. Inventory wanachukua ngapi? Inventory 460 million. So 460 million. While in this case, our Nyumba will take over the remaining amount there, which has already been indicated in the balance sheet, is actually 225 million. 225 million. 225 million. 225 million. So in this case, if you look at the question also, you're having to be told, so each share of accounts receivables, inventory, and accounts payables. So for accounts payables, because it's a liability that was taken over in Akuja debit side, so accounts payables is a liability taken over. So here in Akuja debit side. So in this case, for Mabati, it is actually 308 million. If you look at the balance sheet there, you can be able to see. Then of course, for Nyumba, it is 52 million. Exactly 52 million. Exactly 52 million. So that is the accounts what payables. So we have the accounts receivables, inventory. We have now in this case the accounts payables. So Nyumba Limited took its share of account receivables, inventory, and actually what? Accounts payables. So that is what Nyumba also took. The assets and liabilities were transferred at a book value, and the partners were paid 100 million being goodwill for distribution business and 80 million being goodwill for manufacturing business. So you can be able to make a correction there. You can actually be able to make a correction there. Just make a correction there. Just make a correction there. So it's supposed to be in this case 100 million being goodwill for manufacturing business, while 80 million being goodwill for distribution. There was an error in that particular question there. So you can be able to make the correction by having to take note that in this case, the 100 million is for the manufacturing business, and of course, 80 million is for the distribution business. So therefore, in this case, so the goodwill that was actually in this case taken over, the goodwill, because it's actually part of the assets, goodwill, so we'll be able to consider goodwill here. So the goodwill here, we'll have the goodwill here because it's an asset. Goodwill. This one will actually be 100 million. Then this one is actually 80 million. 80 million. So you can be able to, so this one is 80 million. This one is actually 100 million, 100 million. So that is the goodwill. So that is the goodwill. That is the goodwill. As far in this case, it was actually distributed amongst what? The partners, amongst the partners. Then note number 2, if we go to note number 2, the bank that had provided the loan agreed to accept 14.4 million 10% debentures in Mabati Limited and 9.6 million 10% debentures in Nyumba Limited. So they agreed in this case to do what? To convert. They actually converted. So the bank that had provided the loan agreed to accept. If you look at, in this case, the TO balance there, you can be able to see a bank loan. I don't know whether you can be able to see it. Under the non-current liabilities, you can see a bank loan of 24 what? 24 million. Remember, in this case, we are transferring all our what? All our assets taken over, and of course, all our liabilities taken over. So you can see in this case, we are still having that liability of how much? A bank loan of 24 million, which in this case is still actually pending. Is actually still actually having to do what? Pend. Is actually pending there. So therefore, in this case, you're having to be told about this loan. It is that this loan that these partners had from the bank, they converted it into debentures. Remember, in this case, in a partnership, we cannot have debentures. We cannot actually have debentures in a partnership. So, but sasa ile wali transfer hii biashara kwa kampuni, waka convert hiyo loan, ikakuwa kama debentures. Ikakuwa kama debentures. So vile wali convert in this case, they ended up having to split it into 2. And therefore, in this case, they agreed that in this case, we can have a 14.4 million debenture and of course, a 9.6 million what debenture in the 2 companies. So therefore, in this case, it means Mabati, you can be able to see Mabati was actually taking over a debenture of how much? 14.4 million. So they converted that loan into debentures. Debentures are liabilities, are actually liabilities. And therefore, in this case, Mabati ended up having to take over a liability of this loan of 14.4 million. And of course, Nyumba took over a liability of this loan of 9.6 million. If you add the 2, you'll get the 24 million being the bank loan, And with that, in this case, we would have been able to do what? Transfer our assets into the assets and liabilities into the business purchase account, And therefore, in this case, we can be able to get the totals. We can actually be able to get the totals. You can be able to get the totals here. And of course, now in this case, we say the balancing figure is actually what? The purchase consideration. Which would now in this case be considered as the equity for the company. Ni kama capital ya kampuni sasa ile inaenda kuformiwa. The balancing figure will be the purchase consideration. So what is the total you're having to get here? And the total you're having to get here. So for Mabati, what are you getting as the total there? For Mabati, what are you getting as the total there? For Mabati, this one. If you add all those figures, what are you getting as the total? For Mabati, what are you getting as the total? For Mabati, I can see you're saying 1072 million. So 1072 million. What about Nyumba? What about Nyumba? Nyumba 521 million. 521 million. What about the purchase consideration for Mabati? The purchase consideration for Mabati, you just simply minus these other ones. The purchase consideration for Mabati. The purchase consideration for Mabati, I can see you're saying 57600. 57600. What about for Nyumba, the purchase consideration? What about for Nyumba, the purchase consideration? What about for Nyumba, the purchase consideration? $459,400. 459,400. So this one is 521 million. So these are the balancing figures. We take them as the purchase consideration, which in this case will be take it as the equity for the company that in this case we are going to to form. So it's actually going to form our equity in the company that in this case we are going to form. The company you are going to form in itakuwa capital yake. So to prepare balance sheet, the new company that are going to be formed. For Mabati, equity yake itakuwa hii, unless kama waliuza shares zingine during the year after wameby the partnership. Then nyumba capital yake itakuwa 459. So that's why in this case we prepare what? The business purchase account. The business purchase account. So we can now in this case prepare the partners. So the partners capital account. The partners capital account. We can prepare the partners capital account. The partners. So partners capital account. We can prepare the partners capital account. The partners capital account. We can prepare the partners capital account. So of course there were two partners. You can prepare the partners capital account. There were two partners. So there were two partners. In this case it was Faith, Fei, kulikuwa na Fei, na mwingine alikuwa tu na Hope. Kulikuwa na Fei na Hope. Fei na Hope. Ilikuwa Fei na Hope. Hiyo partnership ilikuwa inakuwa run by Fei na Hope. So remember our figures, you need to be able to put the thousands up there. You need to be able to put the thousands up there. So you can now in this case start with the balance brought down for these partners capital account. This one you can be able to get it in the balance sheet, in the TO balance that you've actually been given there. In the TO balance you've actually been given there. And of course, in this case, the balance for Faith is actually 526 million. And of course, this one for Hope is actually 324 million. So if you look at in this case, ukiangalia hapo kwa hiyo TO balance, ukiangalia kwa hiyo TO balance hapo, utaona sumona hapo umepewa ya Faith ilikuwa capital yake ilikuwa 526 na balance ya Hope ilikuwa 324,000. Balance yake ilikuwa 324,000. But now in this case, if you look at now in this case the format for our partners capital accounts, we've been able to say that in this case when this partnership was having to be purchased, there was goodwill. So there was actually goodwill that in this case was actually considered. And therefore in this case, it means that probably in this case when they were ending up having to be settled, these partners, to be paid these partners, they benefited by, in this case, by having to consider what was the goodwill for the partnership. So apart from them, in this case, having been able to contribute capital to the partnerships, then this business has gained value in terms of goodwill. And in this case, the goodwill, in this case, you're having to be given there in note number 1, we're having to be told for the manufacturing business, it is actually 100 million. And of course, now in this case, for the other business, which is distribution, is actually 80 million. So in total here, we have a goodwill of how much? We have a goodwill of how much? 180,000. 180,000. So you have a goodwill of 180,000. But remember, the partners NB, the partners are sharing profits. The partners are sharing profits equally. They are sharing profits what? Equally. If you look at what you've been told in the introduction of the question, the partners are sharing what? The profits equally. But our goodwill here is actually 100 plus 80. Is actually coming to 180. So for the benefit of these partners, as how they can be able to distribute this goodwill that has arisen on the partnership, in this case, they'll share equally, and therefore in this case, it will be 90 million. So that's why in this case, they'll end up having to share what? The goodwill. And of course, if you look at in this case, the format I've been able to give for the partners capital account, there's somewhere I'm having to mention. If you look at that format, you can just even, there's goodwill. You have to credit the goodwill. You have to credit what? The goodwill there. So you have to credit what? The goodwill. So in this case, you'll consider the goodwill in this case that actually arose on the partnership. Then in this case, there'll be the equity. There'll be the equity. So in the partners, in this case, there'll be the equity. There'll be the equity. The equity. There'll be the equity in this case that will actually end up having to be distributed. So the equity, which is actually the ordinary share capital, this one, it will end up having to be distributed amongst what? The partners. It will be distributed amongst what? The partners. It will be distributed amongst what? The partners. This purchase consideration, it will have to be distributed amongst what? The partners. Amongst the partners. And of course, now in this case, if you look at what you're having to be told in note number 3, on January 2016, the purchase consideration, so you can be able to see this purchase consideration here, which we have here, there's a way in this case, they ended up having to convert it into shares. So these parties basically transferred their interest into the newly formed companies. Yani wame convert partnership ikakuwa kampuni. And therefore, in this case, in a company, we must be able to have what you are calling what? A share capital. And of course, in this case, their share capital, we've already been able to compute it. Ni kwamba ni 570,600 na 459,400. But now if you look at note number 3, tumeambiwa in this case how this capital eco-distributed amongst these partners and of course what? The different companies, amongst the different companies. So if in this case, you look at note number 3, on January 2016, the purchase consideration was settled by the allotment of fully paid ordinary shares of 20 each in the respective what? Companies as follows. So ideally, they were supposed to be paid that money we are calling purchase consideration when they were transferring the partnership into the company. But what it happened, they never, for example, they were not actually paid the money. They actually, in this case, maybe said, instead of having to be paid the money, we'd rather convert these interests that were supposed to be paid as money into what? Into shares. And this is what happened. This is actually what happened. So 23,750,000 shares in Mabati and the balance of the shares in Nyumba. That is how, in this case, Faith agreed in this case to do what? To acquire the capital. Then in this case, for Hope, 15,920,000 shares in Nyumba Limited and the balance of the shares in what? In Mabati Limited. So therefore, in this case, we can be able to do the computation here. So we have, in this case, 2 parties here. So in this case, we have for Faith. So for Faith, in this case, you're having to be told that she agreed 23,750,000, each share going for how much? 20 shillings. So this one should actually basically be the equity in Mabati. So if you basically do this computation, 23,750,000, I think you'll be able to get something like 47,500 or something. 475. Yes, 475 million. You'll get 475 million. 475 million. So 475 million. So you're having to say she agreed that in this case, this one be the portion of what is having to acquire as capital in Mabati. What is having to acquire as capital what? In Mabati. But now in this case, the balance he'll be able to acquire. The other balance he'll be able to acquire or top up in Nyumba Limited. So therefore, in this case, if you look at Mabati, the equity here, the total is actually 570,600 million. 570,600 million. So therefore, it means that in this case, the balance is how much? The balance in this case will actually be 570,600 million. You less this 475 million. You less this 475 million. So of course, this one is what in this case he acquired as equity in Mabati. But the remaining portion in this case, he'll be able to acquire in Nyumba. So the total equity here is 570,600. But now in this case, we have to less this amount to get the balance. What is the balance there? What balance are you getting when you minus the 2? So 470,600 minus 475. 470,600 minus 475. What are you getting as the balance? 95,600. You'll be able to get 95 million. So 95,600,000. I think you'll be able to get something like that. So 95,600,000 what? 95,600,000. Then in this case, you are told for Hope, we have Hope. For Hope, what he agreed. So this person we are calling Hope, what she agreed to do in this case. So Hope, she agreed 15,920,000 shares in Nyumba Limited and the balance of the shares in Mabati Limited. So for Hope, it is 15,920,000 number of shares, 15,920,000. 15,920,000. 920,000. Each share going for 20. Each share going for 20. So that means in this case, in Nyumba, in our case, in this case, in Nyumba for Hope, in Nyumba for Hope. So how much is that? If you multiply in this case, you'll be able to get, I think, 318 million, 318 million, 400,000. 318 million, 400,000. So she agreed that in this case, this is what you'll be able to take as a portion of equity in what? In Nyumba. But now in this case, the balance in this case will likely be in Mabati. And of course, the balance here, the balance, be able to get the balance, be able to get the balance. So we have in this case a total of 459, 400 million, 459, 459, 400 million. But now in this case, we have to less the 318. So you less the 318 to get the balance. So in this case, 318, 400,000. 318, 400,000. So what are you having to get the balance? What is the balance there? What are you having to get as the balance? What are you having to get as the balance? 141. So it is actually 141. 141 million. 141 million. What about right now? What about right now? It is okay. It is okay. It is okay. So I was telling you you add these ones, you see the total, and you add this one, you see the total. You are saying I repeat. I repeat from where? I repeat from where? So in this case, we've been able to do the computation. We've said that in this case, Faith, on this equity, this is how they agreed to distribute on that equity. In Mabati, she agreed to take 23,750,000 shares. Each was going for 20 shillings as per note number 3. So in total, in this case, Faith actually took 475 million as equity in what? In that company you are calling what? Mabati. In that company you are calling Mabati, she ended up having to take how much? This amount. but the rest, he actually agreed to take what in nyumba. So in this case, in total, the equity there is 570, but she took this one. The rest, she actually agreed to take what in nyumba. What is the balance here? You take 570, the total equity in Mabati. In Mabati, then in this case, you less what Faith took, 475, you'll get 95,600 million. Then in this case, for Hope, she agreed to take this number of shares, each going for 20. If you do the multiplication here, you'll be able to get a total equity she took from Nyumba, exactly from Nyumba, that one, 459, she took 318,400. The rest, she actually agreed in this case to take what in Mabati. So the balance here is actually 459,400 million minus this one. You'll get the balance here. So it means that in this case, for Mabati, the rest of the balance here will likely end up having to go to Hope. And of course, in this case, for Nyumba, the rest of the balance here will likely end up having to go to Faith. It will go to Faith. And of course, in this case, being able to transfer, you can be able to see. So in this case, for Faith, from Mabati, she got 475 million. She got 475 million. Then in this case, for Hope, he got, is it a man or a female? I don't know. She got 95,600,000, which is here. And from Nyumba, Hope, she actually got how much? 318,400,000, which is actually here. And of course, in this case, for our friend Faith, she got 141 million, which is actually here. So I want you to do the total here. The total here, they should be able to balance. They should be able to balance. So how much are you having to get as a total here for Hope? The total for Hope there, you are getting how much? I can see you are saying 414. 414, yes. It should actually be 414 for Hope. So 414. So 414. What about for Faith? Faith, what are you getting as the total? What about for Faith? What about for Faith? I think you should be able to get something like 616. 616,000. You should be able to get 616,000. So those are, in this case, you prepare the partner's capital account, And therefore, in this case, the next one you're having to be called upon to prepare, it is the bank account. And of course, in this case, when you talk about a bank account here, bank account huwa inaonyesha tu vile pesa inaingia na vile chapa inatoka. Vile chapa inaingia kwa kampuni na vile chapa inatoka. Chapa ikiingia una debit. Chapa ikitoka una credit. That is what a bank account does, or a cash account does. Chapa ikiingia una debit. Chapa ikitoka una credit. Chapa ikiingia una debit. And of course, in this case, you start with the balance brought down. With the balance what brought down. You start with the balance brought down. And then after that, pesa ikiingia una debit. Pesa ukiona kuna transaction inaonyesha pesa inatoka, una credit. Una credit mara that. So in this case, we have the bank account. So bank account. So the bank account, the new bank account, after the companies have been formed, the new bank account, after the companies have been formed. So remember here, we already have two companies. So you have Mabati and we have Nyumba. So you have in this case Mabati and we have in this case Nyumba. So what is will be our balance in the bank for us to take to the balance sheet when you are coming up with the statement of financial position for these two companies? So of course, when you talk about the bank, it is one of the assets. It is one of what? The assets. Exactly one of the assets. Exactly one of the assets. Exactly one of the assets. And of course, now in this case, if you look at in this case, the business purchase account, in the business purchase account, you can be able to see Mabati took over what? The bank overdraft. Mabati took over what? The bank overdraft. So it means that in this case, the balance brought down for Mabati will be this side because it was overdrawn. It was an overdrawing. So 179 is actually 179 million. So exactly Mabati took over what? The bank overdraft. Because you can be able to see it in the business purchase account. So how do you bank overdraft? So inamaanisha their balance brought down in terms of what? In terms of, in this case, the amount at the bank will actually be negative, a negative one of 179,000. While in this case, our friends, Nyumba hao walikuwa wajanja, hao wataki kuanza na madeni. So walianza na pesa. So in this case, the balance brought down was how much for Nyumba? The balance brought down for Nyumba in this case, they had an amount of, I think, 1,000. 1 million, I think 1 million. They had an amount of 1 million. The cash that in this case they took over as the balance brought down is actually 1 million. Is 1 million. For them, they never started. So for Nyumba is actually 1 million. It's actually 1 million. 1 million. So let's have a look. So the persons who actually took over in this case, it was the Mabati took over the bank overdraft. At the same time, in this case, they took over what? The cash. They took over the cash. So in this case, both of them will likely end up having to affect what? In this case, Mabati. So Mabati, in terms of also cash, they actually took over 1 million. So you can be able to see it under the assets there, the cash that they actually took over in this case was actually 1 million, but of course there was a bank overdraft of 179 million. 179 million. Then if you look at what you've been told in note number 4 in the question, Mabati Limited also raised 20% debenture of 200 million on 1st of January 2016 and paid off the bank overdraft. The expenses incurred in raising the 12% debenture amounted to 7 million. So they raised money. Kuna pesa wali raise hapo wakiuza debentures the 12%. So hiyo pesa wali raise in this case ilikuwa 200 million. So in this case, they sold a debenture and of course they got money. So they sold debentures and they were paid money. So debentures, in this case, the debentures here were actually worth 200 million. But when they were having to sell this debenture, they incurred an expense of 7 million. So debentures expense. So saili walianzisha tu hizi kampuni wakauza debentures. Hizo debentures waliika an expense of 7 million. Kuziuza hizi waliika an expense of 7 million. An expense of 7 million. Then, and paid off the bank overdraft. The expenses incurred raising the debenture was 7 million. So this particular amount they raised as 200 million. Actually, in this case, it was having to support them to pay off this overdraft. So because you've already been able to consider it here. So they actually paid it off. So they paid it off by raising this particular debentures. So they actually ended up having to pay it off. They raised the debentures to do away with this negative of balance in terms of the bank overdraft. Then Mabati Limited and Nyumba Limited also issued 1 million and 1.5 million fully paid ordinary shares of 20 each, respectively, to two corporate investors, A Limited and B Limited. Pia waliuza shares. Sasa ukiuza shares haziko for free, watu wanakuletea pesa. So inamaanisha in this case, our money at the bank increased because we did what? We sold shares. So in this case, sale of shares, sale of ordinary shares, sale of ordinary shares. In this case, Mabati, you've been told they sold how many shares? 200 million shares. Not 200 million, but 1 million shares, each one going for 20. It means that in this case, they raised an amount of much? 20 million. Hourly raised 20 million wakiuza shares. 20 million while selling shares. While in this case, Nyumba, they sold 1.5 million shares. In this case, it means if you multiply by 20, for them, they were able to raise money in the bank, full money in the bank, by selling these shares of 30 million. So they were able to raise full money in the bank of 30 million by having to do what? Sell these shares. Then none of the companies has amortized the goodwill. So there's no amortization in terms of the goodwill. The formation expenses were paid. Formation expenses were paid by respective companies as follows. So unajua wana convert partnership kwenda kuwa kampuni. So sasa ile walikuwa na form hizi kampuni mabati na nyumba, kuna two expenses wali-incur hapo to form these companies. Maybe they were having to send people on errands, so walikuwa wanawapea transport. Wakimbia wapi? Kutafuta documentation. So they ended up having to incur some money. So from their computation, they have realized that in this case, they had to pay what we call formation expenses. Kuna pesa walilipa, formation expenses. In this case, for mabati, they incurred formation expenses ambazo walilipa kutoka kwa pesa walikuwa nayo kwa bank of 13 million. While in this case, for our friend in this case, Nyumba, they incurred formation expenses of 8 million. 8 million. So that is also an amount they ended up having to spend of 8 million. So I think there's no any other expense that in this case they paid out of the bank. So therefore you can be able to balance in this case what? Your account. You can be able to balance your account and see what was the money in the bank, what was the money in the bank that you can be able to recognize in the balance sheet. So in this case, you can get the totals. I think the total here is 30 million. 30 million. This one is 30 million. And of course, now the balance carried down. The balance carried down. If you take 8 from this, you get 22 million. And the total here is actually, is it 221? 221 or something. 221. So 221 million. 221 million. Then in this case, you get the difference. What is the difference when you minus these ones? What is the difference when you minus 221 million minus these ones? You get the balance carried down. You get to get the balance carried down. What is the difference when you minus those ones? You're asking why I credit debentures have debited here. So I've debited here. I've only credited what? The debenture expenses. Samuel, are you seeing? These are the debenture expenses. When you incur an expense, you spend money. It's an outflow. But in this case, the money they raise from the debentures is this one, which I've debited here. I've not credited. What I've only credited is what is the expense they incurred. So what are you having to get as the difference here? The difference there. $22. So 22 million. 22 million. 22 million. 22 million. So exactly 22 million. And of course, that is our complete what? Bank account, our complete bank account. So we can now, in this case, prepare the vendor's account. We can now prepare the vendor's account. The vendor's account is the next one they were calling upon us to prepare. The vendor's account is the one they were actually calling upon us to prepare. The vendor's account. Vendor's account. Or in this case, you can call it the purchasing company account. The purchasing company account. The purchasing company account. The purchasing company account. So you have mabati, nyumba. You have mabati and nyumba. You have mabati and the nyumba. We have mabati and the nyumba. Those are the two companies. The two companies. The two companies. So for the vendors here, for the vendors account here, you'll debit the purchase consideration. You'll debit the purchase consideration. You'll debit the purchase consideration. You don't have to compute it because we already have it. Tulikuwa tushaipata in our first account. In our first account, in the business purchase account, tulikuwa tushaipata 570,600 and 459,400. 570,600, 570,600 and 459,400. 459,400. Then now in this case, you credit with the ordinary share capital. 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 So you have in this case, for Mabati, we have 475, 500, and 95, 600. So you can be able to see 475, 500, and 95, 600. So 475, 600. 475, exactly 475. 475 and 95, 600 and 95, 600. So of course, now in this case, if you can be able to recall very well, this one was actually going to Faith, and the other one was actually going to, in this case, Hope. So it is actually 95, 95, 600, 95, 600. Then the other one in this case is actually 141. So 318, 400, 318, 400. So 300 in Nyumba. In Nyumba, in this case, we have 318, 400. Then, of course, in this case, we have 141, 141. You can be able to see them there. We haven't deleted. So you can see for Faith. So for Faith, there were these ones. So we have, in this case, 475 and, of course, 141. So for Faith, it was actually 475 and 141. Then for Hope, it was actually 95. And of course, now in this case, 318, 400. So when in this case, you do the total, when you do the total there, you should be able to get the same. You should be able to get the same. When you do the total there, you should be able to get the same. So for Faith and Hope, so in this case, you should be able to give you 570, 600. And this one should be able to give you 459, 400. So this one is 459. 400, and this one is 95, 470, 600. I should be able to balance. You debit the purchase consideration, then you credit the ordinary share capital as split in this case amongst the partners they were having to transfer, or how they ended up having to acquire the capital in the companies. They acquired the capitals in the companies. So that's why in this case you prepare the vendors or the purchasing company account, 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 or the vendor's account, the vendor's account. So we can now, in this case, prepare the final one, which is now the statement of financial position. The statement of financial position. Statement of financial position. So the final item you are being called upon in this case is to prepare the statement. Statement of financial position. Statement of financial position for the two companies. I think it is for the year ended as at which year end? As at which year end? So after formation. So exactly after formation. After formation, the statement of financial position immediately after formation. So in this case, we have two companies. So therefore, in this case, we have two companies. We have two companies. So we'll prepare for two companies. So it will be Mabati and Nyumba. Mabati and Nyumba. It will be Mabati and Nyumba. And of course, now in this case, you already know, when you are preparing a statement of financial position, in this case, you start with the non-current asset. You start with the non-current assets. And of course, which company took over the non-current assets? It was actually what Mabati. It was actually what Mabati. So part of the non-current assets there that were actually taken over in this case is actually by Mabati. So you have land and buildings. If you go in this case, in the business purchase account, you'll see them. In your business purchase account, you prepared land and buildings. Land and buildings. We have land and buildings. We have in this case, motor vehicle. We have equipment. So the land and buildings, which was actually taken over in this case, is actually 200 million. I think it's actually 200 million. Yes, 200 million, 150, then 33 million. So 200 million, 150, then 33 million. So 200 million, then 150 million, then 33 million. 33 million. But of course, now in this case, there was also in this case what you are calling what? Goodwill. There was actually goodwill. You can remember about goodwill, whereby in this case we said that the manufacturing business took over a goodwill of 100. And of course, now in this case, the distribution business took over a goodwill of how much? 80 million. So the goodwill here, we have goodwill, which was actually taken over. The goodwill which was actually taken over in this case for the manufacturing business, which is by Mabati, is actually 100 million. But now in this case, for the Nyumba, is actually 80 million. So that is still part of what the non-current assets, Then if you can be able to recall, or if you can just be able to go back to your notes, if you can go back to your notes, or if you didn't note, is that any expenses incurred prior to the acquisition, or basically to the formation of the acquired company, they are known as what? Preliminary expenses. And of course, these expenses are supposed to be capitalized. So any expenses incurred, for example, in the formation of what? Of the new companies. These new companies having to be formed, Mabati and Nyumba. If you have any preliminary expenses that enabled the formation of these companies, then those expenses, we said, you are supposed to capitalize them. In fact, you can be able to note somewhere, NB. I don't know if you noted it. Any expenses incurred, on the formation of the new companies, are to be capitalized. Or in this case, they'll be recognized as having to be part of what? Part of the assets. And therefore, in this case, we are supposed to recognize amongst these what? Assets, what you are calling what? The formation expenses. So there were some formation expenses which are actually paid. So you have the formation expenses which are actually paid. This part of the preliminary expenses. So you can call them formation or maybe preliminary expenses. So the formation or preliminary expenses, they are supposed to be capitalized. Of course, now in this case, if you look at our bank account, tunasema hapo Sailo alikuwa na form the company, there were some formation expenses which were actually paid as the last note. You can see some formation expenses which are actually incurred. So as per our note, we are supposed to capitalize or recognize them to be part of the assets of the newly formed what? Companies. So our formation expenses here are actually how much? We have 13 million and of course what? 8 million. So 13 million and of course 8 million. So 13 million and of course 8 million. 13 million and of course what? 8 million. Then of course, now in this case also, when they were having to issue debentures, remember immediately when they converted the company, to facilitate the issue of debentures, they spent money. That was 7 million. Still the same case, for example, we are having to be told they sold some shares. Remember in this case, the 1 million shares and the 1.5 million shares. If in any case, for example, you are told there were flotation costs, still you would have been able to capitalize them here. But for the sale of shares, we haven't been told they incurred any money to sell these shares when these new companies were having to be formed. But for debentures, Sailo will convert immediately 𝐖𝐷𝒐𝒎𝒐𝒏𝒄 kutoka partnership wakaziweka zikakuwa kampuni, waka-issue debentures. Sasa ile ulikuwa na issue debentures, kuna cost waliinka. The preliminary expenses, formation expenses, they have to be capitalized. So in this case, issue of debentures, expenses on issue of debentures, expenses on issue of debentures. And it was in which company? It was in Mabati, whereby they ended up having to incur 7 million. 7 million. So it will actually still actually do what? Be capitalized. It will actually be capitalized. Then of course, now in this case, we can go to the current assets. We can go to the current assets here. We can go to the current assets. So the current assets also in this case, we have in this case, the bank, we have bank, and of course bank we've been able to compute. Tumepata bank balances. Zote zilikuwa zinakuja 22. Zote zilikuwa zinakuja 22 million for the two companies. So the bank, then you have in this case, the inventory. Inventory pia unaanza kwa business purchase. Kuna vile walichukua. Kuna vile walichukua kwa business purchase account ukiangalia ile tumetengeneza ya kwanza. Kuna vile inventory walichukua. Inventory walichukua 460 na 225. So 460 na 225. So 460 milli and 225 milli. 225 milli. Then of course also in this case we have what the accounts receivables. The accounts receivables pia kuna vile walichukua. The accounts receivables kuna vile walichukua. Accounts. Ukiangalia kwa business purchase kuna vile walichukua hizi accounts receivables, hizi kampuni vile zilikuwa formed. So kuna moja hii ya kwanza ilichukua 128 million. Hii ya kwanza ilichukua 128 million. While the second one in this case took how much? 216 million from the business purchase. Hii hata usijipee stress. Angalia tu hapo kwa business purchase. Usianze kufikiria sana. Angalia hapo kwa business purchase utaziona vile walizichukua, wakadistribute the assets like that. Wakadistribute the assets like that. So I think those are the only assets that in this case we have. And therefore in this case you can be able to get the total. So what are you getting as the total of the assets? For Mabati, what is the total of the assets? For Mabati, what is the total of the assets? For Mabati, what is the total of the assets? For Mabati here, what is the total of the assets? For Mabati, what is the total of the assets? I can see you are saying 113 million. Is it correct? Is it correct, Elizabeth? Is it correct? Elizabeth, confirm. Elizabeth, confirm. Confirm, Elizabeth. Elizabeth, confirm, 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 confirm. I can see you're saying 11. Okay, I can see. Wengi wape. Wengi wape. Wengi wape. So 11300. 11300. Then what about in this case for nyumba? What about for nyumba? What about for nyumba? 551. Elizabeth, is it correct? Elizabeth, is it correct? 551, is it correct? Yes, 551. So 551 seems correct. So that's in this case utakuwa umemaliza side ya assets. Side ya assets. So unaendelea tu. So wacha tuangalie side ya equity and liabilities. So usifute kitabu yako. Mimi nafuta kwa sababu I can't continue down there. Mimi siwezi endelea hapo chini kwa sababu utaona. That's why nafuta. So usifute kitabu yako. Uanze kuandika side ya equity and liabilities. Usifute. Yako tu inabaki tu vile iko, but unaendelea hapo chini. Usianze kufuta kitabu yako. So we can now in this case look at the side of equity and liabilities. Equity and liabilities. Equity and liabilities. So of course, in this case already took on the ordinary share capital that was already there. The ordinary share capital that was actually already there. So you have the ordinary share capital ambayo tumecompute kwa the business purchase account. Kwa business purchase account in this case, so unaona in this case kuna ile ordinary share capital tushatengeneza hapo. So in the business purchase account for mabati unaona tumepata ile ninawaambia it is equity. Kuna hapo kwa bracket nimewaambia ni equity hiyo. So it is 570 600, and of course for nyumba it is 459 400. 459 400. But now in this case, remember there were new shares, there were new ordinary shares that were issued during the year. New ordinary shares that were issued during the year. For mabati zilikuwa total ilikuwa ngapi? Zile zilikuwa issued during the year. Zile ziliongezewa. For mabati zilikuwa ngapi? Amount ilikuwa ngapi? For mabati ilikuwa ngapi? I can see Jeff saying 20 milli. 20 milli. Emmanuel, was it 20 milli? Emmanuel, was it 20 million? Yes, it was 20 million. So they sold new shares during the year. So it was actually 20 million. What about for nyumba? It was how much? Nyumba, it was how much? David, you are so quiet today. David, you are not saying anything. 30 million. It was actually 30 million. So that is, of course, the new equity that is there. That is the new equity that is actually in the business. That is actually in the business. Then, of course, now in this case, we have the non-current liabilities. Non-current liabilities, wanasema hapo, kuna tu debentures tulitokelezea. Kuna tu debentures zilitokelezea. Kuna debentures zilitokelezea. Kuna debentures zilitokelezea. There were some debentures ambazo zilitokelezea. So there are some debentures which actually ended up having to arise. Debentures which ended up having to arise. So, of course, initially the debentures, we have the debentures. The debentures here, initially, kulikuwa na, in the business purchase, in this case, the initial debentures there, you can be able to see 14,400. 14,400. Then in this case, of course, for nyumba, it was actually 9,600. So they converted the bank loan into debentures. So that is a long-term liability. Is a long-term liability. But now in this case, during the year, there were new debentures ambazo zililete pesa kwa bank. So unazikumbuka. So the new debentures. There were new debentures here ambazo zililete pesa kwa account. Zilikuwa of how much? 200 million. 200 million. They were actually of how much? 200 million. 200 million. But of course, now in this case, for nyumba, they never issued. So actually, you can be able to combine the figures. I'm just having to split them so that you can be able to see where we are getting the figures. Even these ones, you can just be able to combine them and put here 590,600. This one, you can even be able to combine 489,400. But I'm just having to put so that in this case, when you'll be revising, you can know where the figures are coming from. Because as you can be able to see, Gitonga is saying the content is too much. So you might end up having to easily forget. So this basically totals for new mabati, totals for 214,400 in terms of debentures. For nyumba, it is only 9,600, 9,600, 9,600, 9,600. Then in this case, you can go to the current. There's no any other nini, so you can go to the current liabilities. Current liabilities. So for the current liabilities here, we have the trade payables. Trade payables. Hizi hata usijisumbue. Si ziko hapo kwa business purchase. Waligawana. Si waligawana. Ziko hapo kwa business purchase waligawana. The trade payables here, if you look at the business purchase, unaambia kwamba kulikuwa na 308 na 52. 308 na 52 million. So 308 million na 52 million. Hizi hata usijisumbue sana. Si ziko tu hapo. So all of them are done. So all of them are done. So you can try to add. So what are you getting as the total for mabati? What are you getting as the total for mabati? What are you getting as the total for mabati? What are you getting as the total for mabati? Yeah, so you are getting 111,111,3000. What about in this case for nyumba? What about for nyumba? What about for nyumba? 551. 551. So 551. Of course, now in this case, it should actually be able to balance. So that is how, in this case, you prepare the business purchase, you prepare the bank account, and you prepare the partner's account. So I want us now, in this case, to look at another question. We can start looking at another question, which we'll be able to complete in our next, session. You can open November 2019, question number 1B. So you can tell me within 2 minutes whether you've gotten the question. Just indicate there or type there in the chat yes. So we have November 2019, question number 1B. Of course, also I've been able to share the question on the WhatsApp group. So there's that setting I've been able to share on the WhatsApp group. You can, of course, also be able to open it. On the WhatsApp group, you can be able to also open it. November 2019. So I can see already Sam has gotten it. Sam has gotten it. Gitonga has gotten it. Emmanuel has gotten it. So November 2019, question number 1B. November 2019. November 2019, question number 1B. So it says, Chanda Pete and Tender have been partners in a business for many years, sharing profits and losses in the ratio of 2 to 2 to 1 respectively. If you are in an exam room, you are far much better off if you underline that sharing ratio. Then on 30th June 2019, the partners agreed to convert their business into that of a limited liability company to be named Chapete Limited. So hapa at least kuna mambo ni mzuri. Sio kampuni mbili zinafomiwa. Actually imagine ni moja tu. Hiyo ingine tulikuwa tunaambia sijui nyumba, mabati, hata tunachanganyikiwa. But this one now in this case actually ni kampuni moja. Hapa inakaa mambo ni mzuri. The TO balance extracted from the records of the partnership as at 30th of June 2019 was as follows. So that is the TO balance. So they have in this case assets, they have the capital accounts, they have the bank loan, current accounts. So all those ones are there. They have the drawings. Then in this case, additional information. The property, plant, and equipment in the partnership were being depreciated as follows. So building 2% straight line, plant and equipment 12.5%, motor vehicles and furniture and fittings 10% like that. The partners were entitled to an interest on their fixed capital balances at the rate of 10% per annum. No salaries were paid to the partners. The tangible and current assets were to be transferred to the new company at their fair value. The tangible and current assets were to be transferred to the new company at their fair values. So it means when you'll be coming up with the new company statement of financial position, it means that those are the values that in this case we'll be able to recognize as what? As the non-current assets. So the current assets and liabilities were taken over by the new company at their book values. Then the purchase consideration amounted to 110 million and was settled by the new company through the issue of ordinary shares of 10 each to the partners in satisfaction of the amounts due to them, in satisfaction of the amount that are actually due to them. So you are required to prepare what we call a realization accounts as at 30th June when they were converting that business, 30th of June 2019, the partners' capital accounts, and the opening statement of financial position as at 1st of July 2019 for 𝗖𝗄𝒙 Limited. For 𝗖𝗄𝒙 Limited. So the first question there wants us to prepare what we call a realization account. A realization account. So part A is in this case realization account. Realization account. Exactly, the realization account. Realization account. The realization account. The realization account. They want us to prepare the realization account. And of course, in this case, if you can go back in your book, look at the format of a realization account. 𝗖𝗄𝒙, you debit what? All the assets at the net book value. Then in this case, you credit the liabilities here. You credit the current liabilities that have actually been taken over. You credit the current liabilities which have actually been taken over. So in this case, you debit all the assets at their net book value. At their net book value. Then in this case, you credit the current liabilities that have actually been taken over. The current liabilities which have actually been taken over. So in this case, then also you credit the purchase consideration. You credit you can be able to look at that format. I don't know if you've been able to go back and look at it, because that is ideally what you're going to basically base on when you are coming up with this realization account. This realization account. So it means that in this case, we have to look at all our assets in the TO balance there. We have to, in this case, convert them, all of them, to be at net book value. To be at net book value. All the non-current assets which are there, of course, we've been given them at cost. We've been given the provision for depreciation. But in this case, you have to convert all of them to be at at net book value. To be at net book value. So therefore, in this case, if we are talking about, in this case, having to debit all the assets, the non-current assets there to be at net book value, we are considering property, which is actually building. We are considering plant and equipment. We are considering motor vehicles. We are considering furniture and actually fixtures at costs. Those ones are actually been given at at cost. They have actually been given at at cost. They have actually been given at costs. So now in this case, we can be able to consider these assets. So we have the first asset there, which is actually property at cost, which is actually building. So you have the property. So you have, in this case, the first asset there. We can do our working. We can do our working. So this can be our working one. Working for, in this case, getting the net book value of the assets. 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 So in this case, we have the first asset there, which is actually property, which is actually property. So the first asset there, which is actually property. So you have, in this case, property. We can have property. So property, in this case, we can have maybe in this case the costs. We can have the costs. Then in this case, we have the depreciation for the year. Depreciation for the year. Depreciation for the year. Then in this case, we can have the accumulated depreciation. Then we can now, in this case, get the net book value. I don't know whether you can be able to see up to there. Yes. So in this case, we can have our working here to get the net book values there. To get the net book values there. So of course, you have the first one there having to be property. So property here, we have a cost of 60 million. Is it 60 million or 50 million? It's actually 50 million. So the property there is actually having to cost how much? 50 million. Is actually costing 50 million. So in this case, what we've been given there is actually 60 million. Is actually 60 million. So it means that in this case, the total costs that we'll be able to consider there is actually 60 million. Is actually 60 million. Then in this case, we have plant and equipment. Plant and equipment. So plant and equipment in this case is actually 25 million, yes, 25 million. Then in this case, we have motor vehicles. The cost of motor vehicles is actually 12 million. 12 million. Then in this case, we have furniture and fixtures. The cost for furniture and fixtures is actually 4 million. 4 million. Now we have to compute the depreciation for the year. Depreciation for the year. We've been told buildings, the buildings, which is actually the property, they're having to depreciate it at 2%. 2% of the cost. They're having to depreciate it at 2% of the cost. 2% of the cost. In this case, we'll be able to take 2% of the property costs, 2% of the property cost here, which now in this case will be 2% multiplied by the 50 million. So I think you'd be able to get a figure of 1 million. I think you should be able to get 1 million. You should be able to get 1 million there. Then in this case, plant and equipment, it is actually 12.5% on reducing balance. 12.5% on reducing balance. It means that in this case, we need to take the cost, which is actually 25 million. We minus the accumulated depreciation in this case for plant and equipment is actually 13 million. Is actually 13 million. So I think it's 13 million. So 13 million. Then in this case, we multiply by the percentage, which is actually 12.5%. So which is actually 12.5%. So you should be able to get a depreciation for this one of an amount of 1.5 million. So it should be 1.5 million. 1.5 million. Then in this case, for motor vehicles here, they are depreciating motor vehicles in this case at what? At cost, at straight line. So exactly at straight line, it means it's still just like having to say at cost. So motor vehicles here, we have the cost of 12 million. So it is actually at 25% of the 12 million. So you should be able to get an amount of, is it 4 million? I think it should actually be 4 million. It is 20%, not 25%. It's actually 20%. So this one is 20%. It means you'll get an amount of 2.4 million as the depreciation for the year. Then the last asset there is actually furniture and fixtures. Furniture and fixtures. So for furniture and fixtures here, it is actually being depreciated at 10% on straight line. And of course, the furniture and fixtures, the cost is actually 4 million. The straight line in this case is actually 10% of the 4 million. So in this case, you'll end up having to get an amount of, I think, 400 or something. So 400,000. 400 is equals to 400,000. So therefore, the accumulated depreciation in this case for property, you have to take in this case the depreciation at the start of the year, which in this case is actually in the TO balance. For buildings, you can be able to see it is 5 million. But if you add this one, we have an accumulated depreciation of 6 million. An accumulated depreciation of 6 million. An accumulated depreciation of what? Of 6 million. Then for plant and equipment, there's an accumulated depreciation of 13 million, but you have to add the 1.5. Therefore, in this case, it comes to a total of 14.5 million. Then in this case, for motor vehicles in the TO balance, we have an accumulated depreciation of 4.8 million, but you have to add what? The 2.4. You have to add the 2.4. I think it comes to 6.2 or something, or 7.2. We have in this case 4.8 plus 2.4. It should actually be 7.2 million. 7.2 million as the accumulated. For furniture and fixtures, the accumulated there in the TO balance is 1.6, but here we have 400. You have to accumulate so that in this case you get how much? 2 million. It means that in this case, for us to get the net book value, we simply take the cost here, we minus the accumulated here. And of course, for this one, it will likely be 54 million. And for this one, in this case, it will be 25 minus 14.5. I think it is 10.5. 10.5 million. This one is 12 million minus 7.2 million. You should actually be able to get, is it 4.8? think it could be 4.8. Then in this case, 4 million minus 2 million, you should be able to get 2 million. So you would have gotten the net book values. The net book values of those what? Assets. The net book values of those assets tutakuwa tumepata. And therefore you're having to say that you do what? You debit all these assets at their net book values. In this case, we'll end up having to start with the property. Property in this case is actually 54 million. Our property there is actually how much? 54 million. 54 million. Then plant and equipment. So plant and equipment. Then in this case, we have motor vehicles. Motor vehicles. Then we have in this case furniture and fixtures. Furniture and fixtures. So for property here, we have 54 as the net book value. For plant and equipment, tunaiona pale 10.5. For in this case, motor vehicles is actually 4.8 million. Then in this case, for furniture and fixtures is actually 2 million. 2 million. So what you have to note, remember in the other question, we never prepared this account, but this is how you prepare it. So you have to get the net book values, and that's how you get the net book values. That one is very easy. I know you know about it. So you'll end up having to debit these assets at their net book values, where in the realization account. But in this case, we have what? Other assets. We have other assets. For example, in this case, apart from these ones, we have in this case what? The current assets. We have the trade receivables, we have inventory, and we have cash at bank. We have in this case cash at what? At bank. So we have in this case receivables. We have receivables. The other assets, receivables, we have inventory. We have the cash at bank, the cash at bank. So the receivables here, you can be able to see in the question, it is an amount of 18.2 million. 18.2 million. So our figures are actually in thousands. You can be able to take note of that. Our figures are actually in thousands. So they're actually in shillings of thousands. Inventory is actually 25,300,000. 25,300,000. Then in this case, our cash at bank, which is part of the current assets, is 8,120,000. 8,120,000. So of course, that is how in this case, you end up having to deal with the debit side, whereby in this case, in our format, we said you debit all the non-current assets at net book value. And of course, in this case, also recognize what? The other current assets. Then in this case, on the credit side, you'll have to consider what? The current liabilities. The current liabilities that were actually taken over. If you look at, in this case, the trio balance, the current liabilities are supposed to be on the credit side. So which current liabilities are we having to see? Which current liabilities are we having to see there? So we can see in this case, we can see the liabilities there, the current and non-current. We can see in this case, the bank loan. We can, of course, see the bank loan. We can, of course, also see the payables. We can see the payables and, of course, the bank loan. So those are the two. We have the bank loan. And, of course, also we have what? The payables. We have the payables. So the bank loan there is an amount of, the bank loan there is an amount of 18 million. I think I can be able to see 18 million. Then, of course, the trade payables is 14,700,000. 14,700,000. 14,700,000. So you can see we've debited the assets, these non-current assets at net book value. We've added the current assets here. We've taken now, in this case, what? The current liabilities, and of course, what? The non-current liability is actually the bank loan here. So in this case, you're having to get what was actually the liabilities that were actually having to be taken over. But in this case, if you look at our format, we've been able to indicate on the credit side of the realization account. Also, in this case, you have to consider what? The purchase consideration. You have to consider what? The purchase consideration. Of course, if you look at note number 5, the purchase consideration amounted to 110 million. It amounted to what? An amount of 110 million. So in this case, the purchase consideration in this case amounted to an amount of 110 million. So 110 million. like that. 110 what? 1,000. 110,000. 110 what? 1,000. And therefore, in this case, we've been able to say the balancing figure here on the realization account, it can either be a realization gain or a realization loss. It can be a realization gain or it can be a realization what? Loss. So therefore, in this case, you can be able to try to add. When you add, you should be able to see this other side having to be more. So what are you getting as the total here? What are you getting as the total there? What are you getting as the total here? What are you getting as the total here? What is the total there? When you add 110 plus 14,700 plus 18. I can see you're saying 142,700. I can see Elizabeth guessing 33,800. Remember, this one is 18 million. This one is 14,700. This one is 110 as per note number 5. As per note number 5. This one is 110. So 142,700 seems to be more realistic. 142,700 seems to be more realistic. Therefore, in this case, this side should actually also be 142,700. And of course, if it's actually on this side, it will be a realization gain. The balancing figure will be a realization gain. How much are you having to get? How much are you having to get when you minus all these ones? When you minus all those ones, I can see you are saying 19. 19,700, 19,780, 19,780. I can see you're saying 19,780, 19,780. But now in this case, this realization gain, what they have gained when they basically disposed of or basically converted, what they have gained when they converted this partnership into the company is what you're calling what the realization gain. It will have to be distributed amongst what the partners. And in our partnership here, we have Chanda, Pete, and Tender. So you have Chanda, Pete, and Tender. So they are sharing in the ratio of 2:2:1. Ratio of 2:2:1. I think that is the ratio. The ratio of 2:2:1. Therefore, in this case, this realization gain for Chanda will be how much? The realization gain for Chanda will be how much? The realization gain. This is what they are gaining, all of them as partners. But now we have to distribute amongst them as what? As per the profit sharing ratio. So for Chanda, it will be how much? 79:12. 79:12. 79:12. And it means also for Pete, if it is 2, it will be the same. 79:12. Therefore, in this case, for Tender, it will be how much? 39:56. 39:56. And of course, in this case, we would have been able to create our realization account. Our realization account. That's why in this case, we'll end up having to create what? Our realization account. Our realization account. Our realization account. Our realization account. And of course, now in this case, if you can be able to remember, so we have here what you're calling what? A realization gain. So in our second question, they have called upon us to prepare the partners' capital accounts. The partners' capital accounts. So these partners' capital accounts, this one now in this case, we'll end up having to transfer these realization gains. We'll transfer them into the partners' capital account, because in the partners' capital account, we look at each and every individual partner. Account yake imekuwa affected aje. So at the point in time, they're having to sell this partnership or convert this partnership. Kila partner, when they converted, kuna kitu ali gain at that point in time. So therefore, we'll credit. If you can be able to look at the format, in this case, you'll end up having to do what? To credit it. To credit it on the partner's capital accounts, on the partner's capital accounts, on the partner's capital accounts. So it will end up having to go on the credit side, these ones. When eventually next time we start preparing the partner's capital account, easy to 𝗖𝗙𝒙𝒃 on the credit side. And if you look at the format, as what I've been able to give you, you can be able to see a realization gain equal your side, your partnership. So tutaweka to the individual partners, tutaweka kwa chanda hii amount, tuweke kwa pete hii amount, tuweke kwa tender hii amount, like that. And of course, now in this case, from the partners account, we'll be able to see how much was, for example, the equity for each and every partner. As in this case, they're having to convert it into what? Into a company. We can end there. So let's look at part B and of course part C of the question in our next session. So unless there's a question, let's just end there for now. So hope you've been able to capture the working. This particular working, you've been able to capture it. Was the one that enables you to get this one. So this one is from working one. Working one. So you get them from the first working there. So you need to be able to capture it. I can see already David has said thanks. So I think things are okay. We can end there. Let's just end there for now. Let's see whether we can be able to wind up with partnership in the next class. I think, I don't know, what is the other crucial area remaining? Let me see. Let me have a look of which other crucial area is actually remaining. So cash flow. I think cash flow, you had done some bit of it. And the group, you've done some bit of it. Cash flow and the group, you've done some bit of it. So, but maybe in this case, we'll see what will happen. We might also look at cash flow and group also. Because we've covered branches, we've covered published, we've covered partnership, we've covered professional firms, we've covered cooperatives. So there's pension plans, which we haven't covered yet. Pension plans. Okay, pension plans. Yeah. So things are not that bad. So things are okay. So let's see what we'll be able to start covering when we wind up with partnership in our next class. Otherwise, have a good night. You can have a good night. So I think the next class is tomorrow. It is tomorrow. So let's see what happens tomorrow. We have a holiday tomorrow. There's a holiday tomorrow. Okay. Holiday means for those who are working, you've now gotten free time to study. And revise. So you better celebrate. It is a holiday for swearing in. Who's being sworn in? Who's being sworn in? The deputy president. Wow.